Good morning, sir.
Good morning. Liquidity management is the most important thing in asset liability management. So what is this liquidity and how this is to be managed? So liquidity means what? Liquidity means you should have enough fund with you, liquid funds, for mainly two purposes the funds are required. The first is definitely when you are going to increase your asset, when you are going to increase your asset, any of the assets you are going to increase, you want to increase that asset side. At that time, definitely fund is required. So fund is required to increase the asset. Any kind of asset, you are creating more asset like a loan or investment or buying some fixed asset, whatever thing you want to. In liability side, asset has to be increased. So 1 rupee increase in asset means 1 rupee is required as a fund from the liability. The liability is the source. So that is the time when liquidity is required. So you can say that, or secondly, to decrease your liability. Decrease your liability. Again, to decrease your liability also you need fund. Because suppose increase your asset means you have committed your sanctioned a loan to somebody and loan has to be disbursed. Disbursement of loan. So on that day, that amount should be available by the bank to disburse. Suppose somebody's deposit is maturing. So you want to pay the deposit, pay the mature deposit, or even premature deposit also. When you are going to pay it, somebody is trying to withdraw the amount from his account. That time you need fund. So this is when the fund is required. So we can say that the variation of loan demand is this disbursement of loan, and the variability of deposits whenever the deposits are going to mature or somebody wants to withdraw the deposit. So that these two things determine the bank's liquidity needs. Means fund is required. In both the cases, fund is the main thing. Fund has to be there in the bank. So it means that liquidity management means it is the ability of the bank to ensure that its liabilities are met as they become due. Liabilities are met as they become due. So basically it means whenever the liabilities are becoming due, at that time the funds should be there, or whenever the loans to be disbursed, at that time funds should be there. So liquidity management is basically the ability to accommodate the decrease in the liability. As I told you, it is about to decrease the liability and to fund the increased asset. So that point of time we call that this is liquidity management or fund management. Okay, so this fund management can be both. When you see that if this increase or decrease, whatever it is, this is about the, I can say, the both expected and unexpected. So you can have, the maturity of any deposit or something. That time we call it expected withdrawals. Those are expected. So you know the maturity date of deposit, or you know that when the loan is going to be repaid. Yes, a loan is going to be disbursed. At that time, those are the expected cash obligation. These are called expected cash obligations. But sometimes it might be unexpected also. So those are unexpected cash obligation. Means suddenly somebody wants that premature payment of the deposit. Or suddenly somebody who comes with a request of ad hoc loan disbursement, a bigger amount. At that time, those are unexpected. So basically, it means that to meet both the expected and unexpected cash obligation, liquidity is required. Similarly, not only cash obligations, sometimes banks collateral obligation also there. Collateral obligation. At that time also, these funds are required. Liquidity management is important. So what do you mean by collateral obligation of the bank? Can anybody tell me? Cash obligation you understood. Expected withdrawal or expected disbursement of loan. Unexpected means premature payment or sudden loan disbursement request. So what is collateral obligation of a bank?
Immovable property.
Pardon?
Immovable property. Security.
Okay, I got it. That is a collateral. But what do you understand by bank's obligation about the collateral?
For borrow money from
other banks.
And so where does that collateral obligation fits?
So borrow money from RBI by keeping securities.
Okay, very good. Whenever you borrow money, whether it is RBI or any bank or any financial institution, other than overnight money, call money, one day, all other times you have to pledge your collateral. Pledge the collateral which is required. All the collaterals, the type of government securities which is required to be placed for those borrowing. So that is called collateral obligation. Suppose you do not have that security. At that point in time, you need borrowing, but those type of securities are not there. So to provide collateral while borrowing, or sometimes margin of borrowing might go up due to some market condition. At that time, you should have enough liquidity to cover this collateral obligation. Okay, so not only for meeting the cash obligation, but also sometimes collateral obligations are to be fulfilled. For that reason, banks' liquidity should be there. So we can say that bank is said to have enough liquidity when it can obtain substance. Either it is having sufficient fund with the bank itself, or it can obtain sufficient fund either by increasing the liability or converting it liquid asset promptly at a reasonable cost. Or third condition is you can borrow from the market at a very reasonable cost. So borrowing is okay, fine, but borrowing should be at a reasonable cost. High cost borrowing is not good for the bank because it is going to eat away your profit. Okay, so you can say that bank, it is the ability of the bank to obtain sufficient fund when the fund is not there. How it will be obtained? Either you increase the liability, means you go for either deposit canvassing, somebody has having connection with you, so immediately he can support with some depositing by some deposit, or you can borrow also. So that time you are increasing the liability to get the fund, or you can convert some liquid asset which are holding by the bank, which you are holding, so that it can be converted to cash. Both at a reasonable cost. So that is thing, reasonable cost. Because at high cost, anybody can go to the market and borrow. But that is not desirable because it is going to eat away your profit. So we can say that liquidity crisis or liquidity risk happens when the bank is unable to meet its obligation as and when they become due without adversely affecting the bank's financial condition. So that is the basic thing. So if liquid needs are not met by the bank may be forced to acquire additional liabilities under adverse market condition, that is from the outside borrowing. So that means what? Adverse market condition means high rate of interest. In that case, again, our NII will be going down, profit will be going down. But the asset liability management says that profit should be retained or protected or enhanced. Okay. So liquidity management is the process of generating funds to meet the contractual or relationship obligation. Those examples I have given at reasonable prices at all times. Okay. Another thing is more important about liquidity management is that why liquidity management is so important. Because we know that a bank is called solvent. A bank or any business will be called as solvent as long as the net worth of that business or bank is positive. As long as net worth is positive, it is called solvent. Okay. So if you relate this solvent thing with liquidity, so at any point of time, you can say that bank can be both solvent and liquid. So both solvency is there, liquidity is there. Second thing is that bank can be not solvent and illiquid, or no, there is no liquidity. Not liquid, I can say not liquid. That is your position. Third is, you can say that bank is not solvent, but it might be liquid. Liquidity is there. Fourth is, bank is solvent, but bank is not liquid. So all these four conditions might happen. But bank need to stay both solvent and liquid all the time. You cannot be not solvent or not liquid. You cannot be not solvent but liquid. Or you can be solvent but not liquid. These are not desirable conditions. You have to be solvent as well as liquid. So therefore, there is a need to stay both solvent and liquid at all times, which requires your liquidity management. Liquidity has to be there. Means either you have your fund or you have arrangement to get the fund immediately at a reasonable price. Rumpa, can you please mute your mic? Okay, so this is about the liquidity. Now, how to manage the liquidity? As I told you, either you increase your liability or decrease your assets. Increase your liability in the sense either you can canvas more deposit or you go for reasonable borrowing, or if you have liquidity assets, you can easily convert them to cash. So you can say that these things can be done by way of this. So how to manage the liquidity problem? So disposing of liquid assets. If the bank is having liquid asset which can be easily converted within 1 day or within 2 hours, 3 hours, you can do. So basically liquid assets means you have some surplus marketable securities with you. Marketable securities which can be easily sold in the market. So you should sell them, immediately get the price, get the amount. Increasing short-term borrowings at lesser cost. Maybe for 2 days or 4 days or 7 days borrowing, short-term borrowings, you can borrow at a reasonable or lesser cost. Or you want to increase the deposit of long-term nature. If it is possible, can be a small deposit of one year or 1 year more is possible. So they will solve the liquidity problems for a certain amount of period. Okay, but this third one, suppose you get a deposit of 1 year period, a sizable deposit, then definitely it is going to, up to 1 year, your liquidity problem up to that extent is solved. So that means what is the bank, how bank is going to manage this problem is the ability of the bank. So if you can do that, it will also ensure that the bank has a capacity in the market that the bank is safe. So if your liquidity management capacity is good enough, then your bank's reputation will be in the market that this bank is safe and therefore capable of repaying its borrowings. So your for future borrowings will be also dependent on the ability of repayment of the borrowing. So in the market, when this borrowing market, they will be knowing that yes, this bank is good enough. So immediately we can lend them. So if again, as I told you, when this liquidity is available, some of the big borrowers who normally want money, like large and huge borrowers, like Reliance or somebody, suppose such accounts are with you. So they know that this bank has no liquidity problem. So at any point of time, we need, say, maybe 1,000 crore, 2,000 crores short-term fund they require. At that time, they can come to that bank. That means they will think that this bank is able to meet its prior commitment, loan commitment, whether it is a formal commitment or informal commitment, expected or unexpected. So another thing is that unnecessary, if the liquidity is managed properly, it is not required by the bank to sell the asset in such a distress so that it will become unprofitable for them. That means to avoid unprofitable sale of any asset. Because sometimes when liquidity is not there, then sometimes bank goes for selling of some of the assets at a distress sale. Distress sale means normally at a lower price you are going to sell the asset. So that is unprofitable. And also banks with strong balance sheet like SBI or bigger banks. That means you have a stronger liquidity capacity, you have a stronger balance sheet. Such banks will be perceived by the market player or your competitor as being liquid and safe. So when you are liquid and safe, then you can deal with the business and others will be also interested in doing business with you. This shows that the bank's creditworthiness. Creditworthiness means bank is always able to pay its borrowings, whatever the money is borrowed, because again, in that market, bank is a borrower. So other banks or financial institutions, they are lending you. At that time also, they want to know your creditworthiness. That is more important. If that creditworthiness is fine, then all the borrowings will come to you easily. with reasonable cost. That's the main thing in the banking. So whenever such things are not available, we call it liquidity risk. And that liquidity risk has to be managed. So liquidity risk management means normally how? So whenever there is a fund mismatch, means mismatch of the asset and liability happens, then it is a liquidity risk. So we can call that cash flow mismatch. That is when the outflow becomes more than inflow. So we are talking about the fund here, only fund here, amount of the fund. When the outflow of fund is more than inflow, then that is a liquidity risk. And whenever such thing happens, the gap which is created, that is called the liquidity gap. So whatever the position might be, there is a mismatch in the asset and liability. That can be positive or negative. So that gap is called liquidity gap. When there is a negative gap, then it is a liquidity risk. Clear? So liquidity risk means whenever such thing happen so when we outflow plus or minus inflow, whatever the result is called, that is the gap. So it may depend, it may happen that gap might be positive gap or gap might be negative gap. So whenever negative gap is there, then that is the risky. That means you have a problem in your fund. Okay, so when we calculate what is the net cash outflow and what is the net cash inflow on that day or during any future time, we can see expected that, and if we can find the gap, that gap is called liquidity gap. Whenever this becomes negative, that is a risky. So we can say that we have a liquidity risk problem that day. So to overcome this liquidity problem, or how to manage the risk of liquidity, RBI has prescribed a maturity ladder with time horizons or time bands or time buckets. They are called time bands or time buckets also. Different time buckets or time band measuring and monitoring the liquidity gaps. So it is required by all banks to place their asset and liability every day in this maturity ladder and monitor the liquidity gaps. This maturity ladder has got 10 time buckets. 10 time buckets are there. RBI has prescribed 10 time buckets, and RBI is more concerned about the short-term liquidity. Shortest term liquidity. That means RBI says that till 30 days period, liquidity you should manage properly. As you have already told you in risk management, that liquidity coverage ratio, that is also meant for 30 days. Your short-term liquidity problem should be always within that ratio. That ratio I told you, LCR should be equal to or more than 100%. Means you should have that liquidity fund. Means your HQL, high quality liquidity asset. You should maintain those assets up to 100 level. So here also same thing. RBI says that you should match or your place all your bucket, all the deposit and asset and liability, and place it in the maturity ladder. Then see the gap. And RBI is more concerned that your liquidity problems should not be there or should not be exceeding a limit for at least 30 days period. So whatever the buckets are there in 30 days bucket, they should have a limited liquidity risk. You cannot exceed that limit. So other period, if there is a liquidity risk more than the prescribed limit, then RBI says that is not a problem, because within that 30, if you can manage that 30 days period, at the end of 30 days period, again you have some, bank can think about some ability to again manage those 30 days period. So long terms are not a question, but short terms are really a concern for the RBI. Now, what is this time buckets RBI has given? That is like this. So these are the 10 time bands. That's starting with the 1 day or call money. This is the next day or tomorrow. Then 2 to 7 days, 8 to 14 days, 15 to 28 days, 29 to 3 months, over 3 months to 6 months, over 6 months to 1 year, over 1 year to 3 years, over 3 years to 5 years, and over 5 years. So basically there are 10 total time buckets prescribed by RBI. So RBI issues this guideline from time to time for managing the asset and liability management risk, particularly liquidity risk, more particularly short-term liquidity, from intraday or tomorrow to 1 month. So we can say that these 4 buckets only. Up to 1 month period means here 28 days. So these are the 4 buckets for which RBI always advises that the bank should be ready for this liquidity management. The current guideline is that, remember carefully, current guideline is that the net cumulative negative mismatch, net cumulative negative gap or negative mismatch during any of these 4 buckets should not exceed by, the first bucket should not exceed by 5%, second bucket should not exceed by 10%, third is should not exceed by 15%, fourth is should not exceed by 20% of your total cash flow. So remember this thing. So each day, each bracket or bucket of time band, when you place your asset and liability, you will find what is the net cumulative negative gap. Whenever there is a net cumulative negative gap, that gap should not exceed by the respective percentage here of the total cash flow of that band. Is it understandable? Are you getting me or not? Are you with me, or you are totally bored and you have these things have become a bouncer, gone over the head? Anumal, you have raised a hand. Understood. Hetal is saying understood. Anybody? What about you, Anumal? What are you telling? You understood? Yeah. No, total net cash flow and total cash flow might be different. Net means some adjustments are there. Total cash flow you have to take. What is the total cash flow? When you net it with your inflows, then it becomes net cash flow. So you can take that total cash flow. What is the requirement for that? Suppose this day, the gap is, suppose I can say here, I will place here, suppose I will make a column here. So for first one, just we will discuss, this is the liability, this is the asset. So as on this first tomorrow's thing, I have a liability of say 130 and I have an asset of say 100. So what is the gap here? Gap is minus 30. Suppose next day I have a liability of again say 130, asset of say 110. That means I have a gap of minus 20. And here you see first one, there is no cumulative gap. It will be same as 30. The second day cumulative gap becomes how much? It becomes minus 50. So this is the gap, and next one is cumulative gap. So here minus 30 is the cumulative gap. Here minus 50 is the cumulative gap. So it says that net cumulative gap 50. So I can say that this is not liability asset. I can say that this is the outflow. I have to plot with outflow and inflow. Whether it is outflow, inflow of asset, liability, whatever is done, that I have taken into consideration. So outflow is 130, inflow is 100, so gap is 30, cumulative gap is also minus 30. Second day also outflow is 130, inflow is 110, so my gap becomes 20, but cumulative gap becomes 50. Now this cumulative gap of 50, according to this second time band, should not exceed 10%, of the total cash flow. Total cash flow is how much? 130. So 130, 10% is 13. So that means your level of liquidity allowed is 13, but you are at minus 50. That means you are exceeded by how much? 37. So that is not desirable. Okay, you have to manage, means you have to arrange for that 37 and reduce this to 13 or less than that, or you can make a positive gap also. So for this 4 time band only, RBI have prescribed these limits. Other the things RBI is not bothered. You should manage this for the 28 days period. Clear now? Is it clear? This whatever I have explained for the 4 bands, is it clear? So for each band it is applicable. So when you are calculating that percentage for each band, you are calculating net cumulative gap. For each band, what is the total cash flow, and you see the percentage whether it is exceeding or not. So this is what the structural liquidity gap statement is prepared by the bank. The bank has to prepare that statement and submit it to RBI every 15 days. On every Wednesdays, alternate Wednesdays, this is sent to RBI. And numerical questions are asked on this particular thing. So if you understood this, then numerical can be easily done by this structural liquidity gap. Okay, so I can proceed. There is no problem. You have to remember about this net cumulative gap and total cash flow. And this percentage are required 5, 10, 15, 20 easily remembered. So you should know that how much this is the level up to which it is allowed. If there is a negative cumulative gap, up to this much allowed, above this is not allowed by RBI. So you have to be careful about that. If that is so, 37, how I got? Very good. If your passing mark is 50 and you have got 13, so what is the gap? 37 or not? Shruti? If your CAIB mark is 50 and somebody has achieved 13, so 37 is the less mark he or she has got to pass the examination. Same here. Here the limit is 13, but 50 is there. So that difference is 37. So either the question will ask what is the amount of difference, or question will ask how much your negative cumulative gap has exceeded the prescribed limit of RBI. So you can convert that 37 into percentage and say that this is the percent. No, when you, Amita, when you add inflow and outflow, it is net cash flow. I'm talking about only outflow. When you are adding this outflow and inflow together, that means we are arriving at net cash flow. Net cash flow is the gap only. But total outflow is this figure only. This is inflow figure. Is it clear? Okay. Now, RBI has, see, I will tell you what type of asset and liabilities are to be placed under which bucket RBI has guideline. Okay, so you understood now what are the outflow? Because understanding outflow and inflow of the funds is much more important. Here we are talking about fund only. We are talking about liquidity management. Liquidity management is our fund. It is not about the income. Income will come into picture when we will talk about interest rate risk. So here we are talking about liquidity risk. So cash inflow means any liabilities are coming, means depositor has deposited money, that is an inflow, or you are borrowing from outside, that is an inflow, or any of the loans or investment are maturing, the money is coming, or loan installments are paid, they are the inflow. Outflow means liabilities are to be paid, so deposit maturing or prematuring, or loan disbursing, or any contingent liability has become funded liability. Bank guarantee has been invoked, LC has been devolved, so bank has to create a loan, has to be disbursing the fund. That time this outflow happens. So a maturity ladder or this maturity bucket is to be prepared to compare bank's future cash inflow to future cash outflow. So what is your future outflow and future inflow? Both till 5 years, you can easily compare. From starting point, from next day to 5 years, you can plot it, whatever your figure says. Because you might have some deposits of 5 year or liabilities 5 year, also same time assets also 5 years is there. So you can plot all those things together in the 10 maturity buckets. So you can know what is the outflow of any of the bucket and what is the inflow. So, and you can see the gap. So you should be ready that this 6 months to 1 year, I have a gap of say 100 crore negative gap. So I should be ready. Today I should be thinking about this at this point of time, how I am going to manage this 100 crore. So if you can easily say within a 1 month period, if you can canvas 100 crores of deposit, then your this 100 crore liquidity problem is solved. So all the cash inflow and outflows will be ranked by the date on which they are going to mature or when you are going to disperse the loans, outflows. Similarly, cash inflows to be also ranked in that way. So difference between inflow and outflow is the gap, which might be a surplus or a shortfall. So surplus is a plus, shortfall is a minus. That shortfall needs to be addressed through funding requirement. That is the basic need of this bank's treasury management is doing on that thing, or your ALM department is preparing this, and the treasury department has to manage that borrowing from outside. So their job is this every day. So now we'll see that what type of different types of asset and liability who are to be placed under which bucket. RBI has its guideline. So RBI says that capital reserve and surplus are to be placed over 5-year bucket. So the last bucket it will be placed. Okay. So capital reserve and surplus to be placed under over 5 years. Now, as regards current and savings deposit as well as CCOD and your working capital term loan in the asset side, or current deposit balance maintained in the other bank, or balances with RBI or banks for CRR, SRR purpose. All these 4 things which are highlighted in yellow, what RBI advises or prescribes that such accounts, these are basically running account. Running account in the sense, any point of time, the customer or borrower can easily deposit something or can withdraw something. So here, so those things, it has been researched and it has been seen that certain percentage of the deposit or certain, so when we are talking about liability, the deposits, or we are talking about loans or investment or bank balances to other bank. So in such cases, certain percentage of deposits as well as certain percentage of loan, they are always stable. Stable means that percentage is not withdrawn by the borrower or not withdrawn by the depositor in deposit account and loan account, or any balance maintained with RBI also same thing. Your bank does not withdraw that. Those are the stable account. And some percentage are unstable account. Unstable means these are volatile. These are volatile account. So volatile means these are the persons which are withdrawn by the customers. So it is said that when it is a savings account, it says that 15% of that savings accounts are stable in nature, or we can call that these are the core in nature. Sorry, I think, sorry, let you know. No, sorry. This as regards savings account, 15% of the entire savings account are volatile in nature. So these are not stable. That means 85% are stable in nature. As regards current deposits, 10% of the total current deposits are volatile in nature and 90% are taken as a stable. Okay. So similarly, same thing happens normally CCOD or the bank balance maintained in current account. This will be treated as a current account. So same thing will happen, 10% and 90% level has to be done. So here RBI says those volatile persons can be kept in 1 to 14 days period. So you have in the 1 to 14 days period, in the 1 to 14 days period means these 3 buckets are there. So you can place at any of 3 buckets. So this starts with 1 day, this is 14 days. So volatile person can be put under any 3 buckets as the bank desires. The stable person to be put under 1 to 3 years. So stable person over 1 year to 3 years. So that is the thing. So this you put here volatile portion here, which are volatile in nature means withdrawable. So you can say that it is withdrawable from 1 day to 14 days it will go. And which are not volatile or stable or core portion, that has to be put under over 1 year to 3 years. Clear? There's no problem here. So similarly, other things are also, say, fixed deposit, certificate deposit, borrowings and bonds, including sovereign debt, they will be placed as per their remaining maturity. So you will be knowing that when it is going to mature. So accordingly, you place them according to the respective buckets. Provisions other than loan loss in respective time bands. When their provisions are going to be due, when it will be adjusted, except NPA provision. NPA provisions are given separately. I will let you know. These two are NPA provision. Okay. So other than NPA provision, any provision is there in their respective time bands, like you are placing your fixed deposit. Fixed deposit have their maturity, so you have to place them. So bills payable or branch adjustment account, they are put under these first three buckets, 1 to 14 days. Other liability, export, refinance, etc., as per the respective time band. When those other liabilities are to be paid back, you know the dates. Export, refinance are for a tenure, so you know the tenure. So they will be put under respective time band. Okay. Next is like a cash. Cash is also volatile is withdrawable. Murugan, volatile is withdrawable, so you have to put them into 1 to 14 days period. Stable are the deposit which should be put under 1 to 3 years. Yes, above 14 days. That means what? See, I have not told in that way. I have told that RBI says that why you are putting in a different way. It might be same, but I told you to hold your nose here, you are holding from the outside. Simply you suppose 100 rupees is the savings deposit. So 15 rupees you put in the 1 to 14 days. 85 rupees you put in 1 to 3 years. That's all. Do not tell me that now it is more than 14 days to whatever things that you put in 85. Simply I have given this thing, you understood, you should understand this and put in this way. Do not complicate your mind to go in the other direction. If there is a straight way is there to reach your destination, why should you take a different route and go there? This is a simple and straight way I have explained. That will take you more time, so you'll be confused. Okay, simple thing I have explained, you should stick to that simple thing. So cash will be with 1 to 14 days. This I have explained, this is explained already. Money at call notice, so they will be in the respective time band. Money at call means 1 day. Notice money means up to 14 days, so 2 days to 14 days. So 2 more buckets are there. Term money means above 14 days, whichever period is there, you place in those buckets. Investment, they have got like fixed deposit, they have a maturity. So you can put them in respective buckets. Bill purchase, discounted term loan, demand loan, they have a maturity date when they are going to be repaid fully. So that time bands you put it. CCOD, term loan, TOD, etc. Already I told you 1 to 14 days and 1 to 3 years. Now the NPA provisions. These two are NPA provisions. These are two are NPA provisions. So for them you have to keep the substandard loan provisions to be kept under 3 to 5 years. Doubtful and lost asset as well as the fixed assets, whatever the bank is having, they will be put under 5 years, over 5 years. So you remember here capital reserve surplus and this doubtful category of loan, loss category of loan and fixed assets are placed under over 5 year bucket. Okay, so this is the placement of the thing. So sometimes question will be asked, so you should be knowing that where to place what. So basically the highlighted portions I have given that adjustment has to be there, because all other things are normally under respective time bands except your 5 years bucket, that is capital reserve, and your substandard and doubtful as well loss and fixed asset. If you remember that, then there is no problem at all. Okay, so those running account type natures, they will put under two things. One is your stable, one is your volatile. Volatile to be put under 1 to 14, stable to be 1 to 3 years. That much you should remember. Other than that, rest are to be put in their respective time bands. Third thing is left is capital reserve and surplus 5 year, and your substandard loan 3 to 5 year, and your loan, doubtful loan, loss loans as well as fixed asset 5 year, over 5 year period. This way you should be putting in the entire thing to be put in the time bucket, time band, maturity ladder or maturity ladder. Then you should prepare your structural liquidity statement to find the gap and cumulative gap, and you should manage those first four buckets as per the prescribed percentage. That is what the analysis to be done with the bank. As I told you, structural liquidity statement has to be prepared by the bank every day. They have to place those funds, and every 14 days on each alternate Wednesdays, this is sent to RBI. You have to confirm that you have managed these four brackets within the prescribed limit. So those every 15 days you have to confirm RBI with placing the entire structural liquidity statement to RBI. So RBI also as regulator wants to know what is your position, what is your liquidity position. Okay. Now how this liquidity gap, how these are analyzed, how to prepare yourself today for the future, that is called gap analysis. So this gap analysis is one of the important analysis in asset liability management. And this was the first method which was developed under ALM to measure banks' exposure, exposure to different kinds of risk. So it can be liquidity risk, it can be interest rate risk also. So these are used continuously by the bank. Every day the gap analysis is done so that you can evaluate your position. Okay. So basically it is a method to measure bank's interest rate risk. Normally whenever interest rate risk is concerned, that time gap analysis is more useful than fund analysis. So gap analysis is done to know bank's interest rate risk. Means whenever the rate of interest is changing in both this asset or liability side or together or in a liability or asset side, so what the impact is on our NII. That is the gap analysis. So this was this to evaluate earning exposures. So basically we want to know or evaluate the earning exposures, means those assets or liability which are rate sensitive. Rate sensitive means which have rate of interest applicable for liability and assets. So those are called rate sensitive liabilities or rate sensitive assets. Which are not affected by this interest rate, those are called rate insensitive liability or rate insensitive assets. Those are to be excluded. So we will see that what are these rate sensitive liabilities and what are these rate sensitive assets in each time band, and we will subtract this RSL and RSA and find the gap, whether it is positive or negative. So that gap will give us that if that gap, whether the gap is suppose X, that gap, whether it's a plus or minus, that gap, when we multiply that gap with the rate of interest change in future, if you multiply this gap with the rate of interest change, then we can find that will be the impact on our NII. So it can be a plus or it can be a minus also. So the gap once arrived can be multiplied by the assumed change of interest rate, yield, rate, whatever is there. And this amount will give us the approximate change in the NII, whether it change is a positive or negative, we should know also. So this is what the gap analysis. So this is called repricing gap. So that gap is called repricing gap. Only in case of fund or liquidity analysis, we were calling that, what gap was there? Liquidity gap. That was called liquidity gap. When you are talking about liquidity, the gap of asset and liability you are taking as a liquidity gap. But in case of interest rate risk, they are called repricing gap. You are calculating the gap only. But here we are calculating the repricing gap. Repricing gap means all the asset and liabilities are not to be taken. Only interest sensitive asset and interest sensitive liabilities to be taken. So can you tell me which so interest sensitive asset means you understood or not? Interest sensitive liability you understood or not? I want to ask, can you give some example of interest insensitive asset and interest insensitive liabilities? If you can give that insensitive asset and liability, then I can understand that you have fully understood this. Give example of interest insensitive asset.
DIR loan.
Cash, sir.
Yes, DIR loan.
Cash, sir.
DIR loan has a 4% interest. So cash is one of the rate insensitive asset. There is no interest on this. Any other thing?
Fixed asset.
Very good. Fixed asset. Fixed asset is not earning anything. So here we are talking about
Current account.
Yes, that is in the liability side. So this is in the current account is the liability side. Okay. So basically current account does not earn any interest. So we can place it in the. Similarly, you can say that if NPAs are available, NPA asset is there, that is also not earning. So NPA is also interest insensitive asset. So we will exclude all these things. If these figures are there, we have to exclude all these things. Only those interest sensitive asset and interest sensitive liability to be taken, and we will find the difference between that. That is called a repricing gap. So this repricing gap can be again positive or negative, whatever it may be. So with that amount of gap, when we find, suppose this gap is G or X, whatever, with that gap, we can multiply the assumed change in the rate of interest. Suppose it says that tomorrow the interest will change by 1% in the asset side or 1% in the liability side or both the side like that. So you can just multiply that 1% with this. This will be the change in the NII. This say Y amount or X amount you arrive. So that will be the change in the NII. Now you have to see where it has changed, how it has impacted. So you can say that whether this Y is a plus Y or minus Y. That means NII is increasing. If it is plus, NII will increase, or if it is minus, NII is going to decrease. So this is what the analysis is done through gap analysis. So question will come, so you have to answer those questions. If you understood, then it's fine. Is it okay?
Okay, sir.
Yes, sir.
Okay. So repricing gap into change in the rate, that is the formula I have told you. So repricing gap into change, assume change in the rate of interest or the yield, whatever it is there. So that is the approximate change in the NII. So, but the logic has to be applied here. Whether the NII is going to increase or decrease, that is not given by this. Repricing gap might be minus or plus. You multiply the rate of interest. So this might be a plus or minus, that doesn't matter. But minus does not mean that your NII is going to decrease. It might be possible that NII is increasing also. So do not go by this plus or minus thing of the repricing gap. Only think that which side is more impacted. So upon that you can arrive at whether the NII is decreasing or NII is increasing. Okay, so some exercise will do whether you will be able to understand that. Okay. Now asset and liabilities are classified under different buckets according to the 10 bucket. Gap is measured taking the difference between asset and liability within a bucket. Then you have to find same thing. Interest rate sensitive gap has to be calculated, or we can call that repricing gap. Interest rate sensitive gap, or this is also called a repricing gap. Repricing gap means when the change of interest will happen, the repricing of asset or liability will happen. From the earlier interest rate, it is changing to the new interest rate. That new interest rate might be increase interest rate or decrease interest rate. So that is the difference between interest rate sensitive asset or RSA or RSL. So whenever RSA minus RSL is more than 0, whenever it is equal to or more than 0, so basically it is equal to or more than 0, it is a positive. So that time we can say that we have a asset sensitive gap. When the gap is positive, the repricing gap is positive, this is called a positive gap, or we can call that asset sensitive gap. When it is negative, that is called negative gap or liability sensitive gap. Clear? So these two are important as far as the MCQs are concerned. So you should know what is a asset sensitive gap and what is a liability sensitive gap. Okay. Now, can you do this exercise? So bank, here it is given call money, bank has lent, given this loan. Call money given by bank 300, cash credit 240, cash in hand 200, savings bank account 300, FD 300, current deposit 250. So first you find the repricing gap, or this is also called adjusted gap. What is the repricing gap or adjusted gap? Has anybody done it? No response?
350, sir.
350. Who is this 350? What is your name?
Sudarshan.
-60, sir.
Minus 60. Okay.
It should be plus 60.
So somebody is, Krishna Chandra is telling plus 60. Somebody is telling minus 60. Anybody else? So many people have given the answer also in the chat box. Minus 60 plus 60. Lakshmi minus 60. Krishna Chandra plus 60. Sangeeta minus 60.
-60.
Who is this? Minus 60. What is your name?
Shilpa.
Shilpa. Okay. Bharani Devi 140. Oh, you are a more 140, somebody said 350. Simple thing I told you. First, you have to see the rate sensitive asset and rate sensitive liability. So we have to exclude those asset and liability which are not rate sensitive. So here cash in hand is there. So this is not part of the rate sensitive asset. This is insensitive.
-60.
So here current account is there. In the liability side 250, here also this has to be excluded. So now how much is the asset? Asset is 300 plus, sorry, okay, 300 plus 240, right? 240. So your asset is 540 RSA. RSA is 540. So what will be RSL? RSL is 300 plus 300 FD.
300 plus 250.
RS 600 is your RSL. Okay. So RSL is greater than RSA. So the difference is minus, because RSL is more, RSA is less. So it is a minus 60. So your adjusted gap, repricing gap will be a negative 60. Answer will be always positive or negative. So it is negative 60. Clear or not? First, you have to understand this. If you are not understanding this, then it will be difficult to do the exercise. But this is first one, have to be compulsory, you have to work it out. Then the next question comes. So 2 questions will be asked. So they will be not asking this one. Straight away they will say that what is the change in NII if rate of interest falls by 2% across the board? Means everywhere the interest changes by 2% decrease. Now, as I told you, how to arrive at the amount of NII. So simply you have to multiply the gap, repricing gap, with the change of interest. So that is 2%. So it will be 1 rupee 20 paisa. Suppose these are, see, this is 1 rupee 20 paisa. Gap is also rupee, na? Gap is rupee. So 1 rupee is 20 paisa. Now you have to decide whether this 1 rupee 20 paisa is going to increase your NII or decrease your NII. You tell me.
It decreases, sir, already, because already
Increases. Increase, sir.
Silpa increase, okay? Silpa
Sir, it will increase, sir.
Increase. Who are you?
Kiran, sir.
Kiran. Kiran also increase. Anybody increase or decrease, whatever it is. Definitely it is an increase or decrease. There is no staying at same level. It is either increase or decrease. 2 options are there. Apply your logic. Sangeeta is also increase. Shivraj increase.
because total assets minus total liabilities is
Okay. Total liability is?
Total liability is more than total assets, sir. So it might be decreases, sir.
What is the logic, you tell me?
By including cash in hand and current deposits. Here,
No, that I understood. That I understood. You are telling liability is more than asset. Okay.
Yes, sir.
So
Yes, sir.
for that, so that's why it is going to decrease. But you should give me logic, na? Why is you mathematically you prove that because RSL is more than RSA, so it will be decreasing. 1 rupee 20 paisa will be decreasing. You should give me logical reason.
Sir,
When you decide in your mind, you
Negative, adjusted gap is negative and it is always false. So both are negative and though it increases.
both are
It's plus.
negative means? Okay. So you,
adjusted gap is
okay,
negative.
you are
RO is
telling,
also negative.
so you are multiplying 60, multiplying -2. So that's why it is plus 120.
Yes, sir.
Okay, very good. Okay, any other thing?
The risk sensitive assets is more than a risk sensitive liabilities, then it is positive.
How RSA is, in this question, RSA is less than RSL, na? RSA is how much?
600.
RSA is 540.
540.
RSL is 600. So which is more?
Sensitive liability.
Okay. Somebody who has given this minus and minus figure, you tell me. What was your name?
Shilpa, sir.
Silpa. Okay. Okay, here, just remember this one, and while doing the third, you apply that figure. How you are going to apply, you tell. Because here, it might be possible that some question will be there that call money increases by 1%, cash credit decreases by 1%, FD increases by 0.5%, SB decreases by this percent. So in that case, what is your application would be? Here only one thing is there. It is here in only fall was there, so you applied this. Suppose this is just 1% applicable to all the asset and liability. Suppose different magnitude interest rate changes in a different direction. In that case, what will be applicable? How you will apply those?
We cannot say exactly.
So you cannot say, na? So that rule is not true. This rule is not applicable. This rule is not always true. Okay. So do not follow this rule. This is not possible. When there is a different magnitude, see, for one change, you can apply that rule, it might be right. But when it is a different magnitude of different asset happening, so you cannot say that how I will say that it is minus or plus. So you can say the gap might be 1 plus or minus, but your rate of interest, how can you say? So are you going to add and so all the interest rate and tell that it is plus or minus? No, that way it will not work out. Okay. So simple thing, your logic, what logic should be applicable, I tell you. Simple logic is that. Here liability is more. Liability is 600. Asset is 540. Okay, and both sides there is a fall in interest rate by 1%. That means what? Where whichever is higher you have to see. So here liability is higher. Liability was more than asset. So what will happen? Whatever the interest we were paying on this liability will be reduced by 1%. Okay, and that amount is suppose X. That reduction amount is suppose X. And here also, since the rate of interest is falling, so whatever we were earning on 540 earlier, it will be reduced by 1%. So that 1% reduction is say Y. Now tell me, according to this figure, two figure, whether X will be more or Y will be more.
Both will be less.
Will be more.
X will be more.
X will be more.
X will be
always
more.
Because this liability side is more than asset size and uniformly 1% is decreased. So definitely X will be more than Y. What was X? X is the less payment towards the depositor. Less payment towards the depositor. Earlier, suppose you are paying 80 rupees. Now you are paying, say, 70 rupees. So that is the less payment of 10 rupees less payment. Why is, suppose you were getting 60 rupees in the loan or say 54 rupees in the loan. Now you are getting say 44 rupees. That means this might be 10 rupees also, or it might be less because 54, or you can say that you are getting 48 or 49 rupees. So it might be 6 rupees. So now what happens? Your reduction in the payment of interest will be more than the earning of the interest from the loan. So that's why your NII will be increasing. So here NII will be increasing. Are you getting me or not?
Yes, sir.
Yes, sir.
Okay. Say simple thing. Suppose before this happened, suppose your NII was 100. Before this change of 1%, suppose take that your NII was 100. Now 1% change has happened in liability. That means how much you are paying less? 1% of 600 is how much? 6. Yes or no? Yes or no? Yes. That means earlier 100 your NII was there. Now 6 rupees you are paying less to as an interest to depositor. So this should be added to NII or deducted to NII? Added to the NII. So this becomes 106. Now here also asset also 1% has decreased. So how much this was? 5 rupees 40 paisa decrease. Our income has decreased. So from this you have to deduct or add here? Deduct. So how much is our total?
100.
100?
0.6.
0.6,
1
right?
kilometer within 24 minutes and 7.
Clear?
Yes, sir.
Suppose this is the case, then definitely this is the amount to increase or decrease. So our NII was 100, now NII becomes 100.60. So it is a increasing. Clear, simple logic I have applied. It is not true, amount might not be true. Amount is 1.20, but just to make you understand. So here the impact NII will be applicable whether this liability is more and asset is more, dependent on the what happens to the rate of interest. Clear now? Is it clear? If you understood, then we'll go ahead with the next question.
Yes, sir.
Yes, sir.
Third one you do. Same question, third one you do. If rate of interest falls 1% for call money, so here it is decreasing by 1%, 0.6% for CC, decreasing, 0.2% for SB, and 1% for FD. So here again all are decreasing. So there is no problem here, everything is uniform. Now you calculate and tell me what is happening. Sangeeta has calculated 0.84 change increase. Okay, we'll see that. Sangeeta has told 0.84, sorry. 0.84 increase. Sangeeta is telling, somebody else has also replied. Tanya, 0.84 what? Plus or minus, increase NII or decrease NII? Increase, okay. Tanya is also supporting Sangeeta. Shilpa also increase. So all the ladies are increasing this thing. Okay, let us find whether this is an increase or decrease. I hope you are applying your logic fully. So this is the logical thing. You have to think and apply. Here there is no mathematical thing will not prove. Only 3% have answered. What about other? How many people are there? 115 people are there, but only 3 answer I am getting. So 100. See, all of you are paying money to attend the class, na? That money comes from your hard-earned money from salary. Sivraj is also 0.84. So when you are paying that much of money as hard-earned money, Assis goes how 1.2%. Okay, Assis goes is 1.2%. Shruti is also 1. Shruti is coming with 0.84 decrease. Assis 1.2% increase. This is the amount I want. This is not percentage. Shruti 8.84 decrease. Only one person has come out with decrease now. Rest all are increase, coming with increase. Anybody to support Shruti or democratic country majority tells increase means you also increase. Sudarshan Reddy supporting Shruti. Okay, decrease. So 2 decreases and 4 or 5, 6 increases. India is a democratic country, so this will win. It seems that 0.84 will be winning by vote only. But the result is that or not, I don't know. No further answer. Out of 115, only 8 people or 10 people have answered. Okay, fine. Rest people are not interested in doing these things.
Minus 0.84, sir.
Minus. So, what is your name?
Rajesh.
Rajesh is also supporting. So, it has become 7 now. Anmol, so it has become 3. 7-3 now. Anmol is increasing. Okay, sorry. 8-2. 8 increase, 2 decrease. No further? Okay, let's see what happens. You are not applying your logic. Okay, so that is the problem. So what happened? So basically, somebody has answered again. Just see, check it. Preeti 8-4 decrease. Somebody has also. So 3 decrease, 8 increase. Okay, let's see. So what was the what is the you are getting for the liability assets? What is the figure you are getting, and liability? What is the figure you are getting? You tell me. Net figure.
Yes, sir. 535.56.
Huh?
535.56.
535.56. How?
535.56, sir. Yes, sir.
No. How? I didn't get you. See, 1% fall. This is interest is falling. 1% falling for there. Here 1% fall. Everywhere it is fall. Here cash credit is 0.6%. Then your savings bank is falling by 0.2%. FD is falling by 1%. So call money falling by 300. 1% is simply I'll take here 3. Plus cash credit falling by 24.6 is 1.44. So total fall becomes 4.44. This is for asset. Liability I have 60, 0.60 plus 3. So liability is 3.60. That is the thing. Okay. So difference is definitely 0.84. So that is the difference. So this gap is 0.84. That we know. This is a repricing gap is 84. That is also done. Now thing is that whether NII is going to increase or decrease. So 9 or 10 people have given answer as increase, 2 or 3 people only decrease. So 3 more has given answer as decrease, 1 more is so basically we have this thing. So normally what will happen? See here, asset side fall is happening and liability side also fall is happening. So which is more fall?
More fall in asset.
Asset, that means what? It will be decreasing, and net impact will be decreasing. So it is
what
decreasing.
we are getting is lesser than actually.
Yes, decline. So 0.84 will decline. NII will decline by 0.84 because these were our income which is not, we are not receiving this. But here 3.6 rupees we are paying less to our depositors. But earning side, it is more than the saving side. Here we are saving 360, but here the receipt of the income which was supposed to come, it is less by 424. So that's why this 0.84 is the decline. Simple thing. You have to see which is more and how the interest is impacting. Okay? So interest impact is more in the earning side. Earning side, suppose 100 rupees was earlier there. You are getting 4 rupees 44 paisa less now. So that means how? What is this? Now it becomes 95.56 and here saving 3 rupees 60 paisa. So you save 3 rupees 60 paisa, add this. So your NII was 100 rupees earlier, it has become 99.16. Difference is nothing but 0.84. Clear?
Yes, sir. Clear.
Simple thing. Logic is that NII was 100 rupees, earning comes down by 4.44. So our NII becomes 95.56. 360 we are going to pay less to the depositor. This is a savings, so you have to add. So net comes to 99.16. So 99.16, 100, difference is 0.84. This is a decrease. Clear? This way you have to do. So lot of people confused about that. So 10 or 15 people, they have told that it is increasing, but few people, 4 or 5 people only told that it's decreasing. So you apply the logic. Simply go with that. Earlier, what was the NII? Now this is plus or minus, this is plus or minus, you know. So add that thing, finally you will get, the figure will get, that difference will be definitely the amount of cap getting. Simple thing. Okay. So basically this is what the interest rate risk gap analysis we are doing. So always it is, if it is possible, you can remember this, otherwise it is not required if you follow what I have told you. So basically it is rate sensitive asset when the situation is rate sensitive assets are more than rate sensitive liability. The gap is negative, positive, we know. Now rate of interest increases. That time impact of NII will be positive. In the situation what we were doing now, in that case, suppose RSA is more than RSL and gap is positive, same position here, interest rate decreases. So impact of NII is negative. When the reverse is there, RSL is more than RSA, that time the gap is negative both cases. If the rate of interest increases, then the impact will be negative, because simply we are paying more here. Because of increase of the interest rate, liabilities will be paid more. So NII will be negative. If the interest rate decreases, then definitely it will be positive. Okay, so this is applicable only when uniform rate of interest is increasing or decreasing for both asset and liability same time. If it is different, then that is not, this rule is not applicable. Then only you have to apply your logic by doing how I have done 100 plus or minus that, plus or minus that. So what is the impact? Okay. So up to gap analysis we have done. Today we will finish here. Rest thing we'll do tomorrow, and day after tomorrow we'll completing. Then on 20th we have numerical system. Any doubt is there? You ask me. Another 5 minutes I can wait for you.
सर लास्ट एग्जांपल दोबारा रिपीट करेंगे प्लीज.
कौन सा एग्जांपल? लास्ट एग्जांपल मतलब 100
नो
वाला
दिस पॉइंट 84 डिक्रीज.
0.84 डिक्रीज. आप 0.84 डिक्रीज आ रहा है कि नहीं? आर यू गेटिंग और नॉट? सी कॉल हियर कैश इन हैंड और सीडी की जरूरत नहीं है. यू अंडरस्टूड दैट? हैव यू अंडरस्टूड दिस और नॉट? आपको पता चला है कि नहीं वेदर कैश इन हैंड लेना है कि नहीं?
नहीं
ये ले लेना, ये पता है ना आपको?
या
ठीक है. अभी कॉल मनी में कॉल मनी और कैश क्रेडिट दोनों RSA हैं. सेविंग्स और FD जो है RSL है. लाइबिलिटी ये एसेट है. अभी कॉल मनी में कितना फॉल हो रहा है?
1%.
1% फॉलिंग. एवरीवेयर इट इज फॉलिंग, सो देयर इज नो पॉइंट. तो कैश क्रेडिट में कितना कम हो रहा है? 0.6%.
0.6.
सो सेविंग्स में कितना कम हो रहा है?
0.2%.
0.2%. FD में 1%.
1%.
ठीक है. सो कॉल मनी में 1% ऑफ 300 कितना है?
सॉरी
1% of 300 is how much? 3.
3.
So asset side में क्या हो रहा है मैं लिख रहा हूं यहाँ पे. RSA में क्या इम्पैक्ट हो रहा है? कॉल मनी में 3 रुपया घट रहा है. ओके.
यस.
और कैश क्रेडिट में कितना कम हो रहा है?
1.44.
1.44. सो टोटल RSA में कितना कम हो रहा है?
तो 4.44.
अभी आए RSL में. सेविंग्स में कम हुआ 0.2%. कितना?
0.60. 0.60.
1% FD में गया कितना?
3.
तो दोनों मिला के कितना हुआ?
3.6.
तो डिफरेंस क्या है अभी?
0.84.
0.84. दिस इज द डिफरेंस. ओके.
यस सर.
अब ये डिफरेंस आप बताइए. एज पर दिस डिफरेंस इज रिप्राइसिंग गैप इज ए पॉजिटिव गैप और नेगेटिव गैप?
अभी
दिस इज पॉजिटिव और नेगेटिव. अब सिंपली दिस फिगर को बताइए. अभी क्या होगा NIA में, दैट इज डिफरेंट. अभी बताइए अकॉर्डिंग टू RSA RSL जो मैं फॉर्मूला बताया था. अभी ये 0.84 इज ए पॉजिटिव और नेगेटिव?
कम देना पड़ेगा. वही
देने की बात नहीं है. देने की आप समझ नहीं रहे हो. मैंने बताया था पिछले साइड में आपको कब पॉजिटिव रिप्राइसिंग गैप होता है, कब नेगेटिव रिप्राइसिंग गैप होता है. आपको बताया था ना. RSA ग्रेटर देन RSL और RSL ग्रेटर देन RSA. दो चीज है ना. तो इस चीज में क्या बताया था? इस चीज में क्या बताया था? अगर एसेट ज्यादा है लायबिलिटी में, रिप्राइसिंग गैप में, ये पॉजिटिव होता है या नेगेटिव होता है? पॉजिटिव. नेगेटिव कब होता है? जब भी लायबिलिटी एसेट से ज्यादा होता है, सो ये नेगेटिव. तो उस तरह से ये क्या गैप है?
पॉजिटिव.
ओके. ठीक है, पॉजिटिव गैप है ना, क्योंकि एसेट ही ज्यादा है ना आपका.
यस.
एसेट आप बोल रहे हो एसेट ज्यादा है. बट हियर द थिंग इज दैट इट इज नॉट अबाउट द इम्पैक्ट ऑफ द इंटरेस्ट. RSA का अमाउंट कितना था? वही तो मैं पूछ रहा हूँ. RSA का अमाउंट कितना था?
4.44.
नहीं. टोटल अमाउंट ऑफ RSA एसेट का टोटल कितना था?
540.
300 plus 240. 540.
540. RSL का कितना था?
600.
तो इसी हिसाब से लेना है, ये इम्पैक्ट के हिसाब से लेना नहीं है RSA RSL। तो क्या है ये 84 एक्चुअली क्या है?
कम देना कम हो जाए।
अब फिर से समझ नहीं रहे हो, मैं इसका पॉजिटिव नेगेटिव की बात कर रहा हूं। ये जो आपने बोला, मैं तो बोला था, आपने क्या बोला, प्लस और माइनस ये देख के बोला, 444 360 देख के आप बोला है कि नहीं?
पॉजिटिव पॉजिटिव
नहीं, ये तो सही नहीं है, क्योंकि एक्चुअली ये इसके बारे में नहीं सोचना है। RSA फंड कितना अमाउंट है सोचना है। तो RSA का फंड कितना था? 540 था।
540, यस
RSL का 600 था।
600।
तो ये दोनों में कौन सा सेटिस्फाई कर रहा है इसको? यहाँ से RSL ज्यादा है या RSA ज्यादा है?
RSL RSL।
अरे यार, सिंपल दो ही फिगर है, आपको देख के इतना सोचना पड़ रहा है, यही तो कंफ्यूजन है। इसलिए मैं समझा रहा हूं आपको, क्योंकि मुझे पता है कि आपका कॉन्सेप्ट ही क्लियर नहीं है। आप इसको पकड़ के पॉजिटिव बोले, इसलिए मैं समझा रहा हूं। ये दो ही फिगर है, आपको दिखा रहा हूं, इनमें से कौन सा बड़ा है। सिंपली 540 बड़ा है या 600 बड़ा है? आप बैंक में काम करते हो, आप
600 सर RSL।
तो 600 अगर बड़ा है तो कौन सा होगा? ये 84 पॉजिटिव होगा या नेगेटिव होगा?
पॉजिटिव।
अरे यार, यहाँ पे
नेगेटिव
क्या
होगा।
लिखा हुआ है यहाँ पे? अब पढ़ते नहीं हो, देखते नहीं हो, सुबह सुबह उठ के सोते रहते हो मेरे क्लास में, मेरे को लगता है।
नहीं सर।
यहाँ पे RSL इक्वल टू RSL लिखा हुआ है नेगेटिव, यहाँ पे आप बोल रहे हो RSL ज्यादा है, तो ये पॉजिटिव कैसे हो गया भैया? आपका कॉन्सेप्ट ही टोटली गलत हो रहा है। दिस इज वाई आई एम ट्राइंग टू एक्सप्लेन इट फ्रॉम द बिगिनिंग टू यू। फिर भी आप समझ नहीं रहे हो, आपका दिमाग और कहीं पे है, क्लास में नहीं है। समझ पा रहे हो कि नहीं? अभी ये RSL समझ गए ना? सो ये नेगेटिव नहीं है, ये पॉजिटिव है। ये सॉरी, पॉजिटिव नहीं है, ये नेगेटिव है।
नेगेटिव है।
अभी ये समझ में आया? यहां तक आपको समझना है।
यस
समझ में आया ना?
यस।
सो ये जो इंटरेस्ट के लिए जो फॉल हुआ या इंक्रीज हुआ, उसमें हम ये पॉजिटिव नेगेटिव नहीं ढूंढेंगे। हम क्या ढूंढेंगे? कितना अमाउंट था ओरिजिनली, व्हाट इज द लोन अमाउंट और डिपॉजिट अमाउंट ओरिजिनली, उसमें से देखेंगे इसमें से कौन सा ज्यादा है, कौन सा कम है। सो 600 इज द मोर देन 540, सो RSL इज मोर देन RSA, दैट इज ए नेगेटिव। ओके, अभी 84 नेगेटिव हो गया। क्लियर?
यस सर।
ओके, सो अभी आप ध्यान से सुनिए। 84 इज द अमाउंट ऑफ डिफरेंस, नेगेटिव आया, चलो जो भी आया, इसका प्रॉब्लम। अभी क्या हुआ था? एसेट साइड में हमारा कम हुआ था 4.44 रुपीज। इंटरेस्ट फॉल की वजह से एसेट साइड में कम हुआ था 4.4 रुपीज। मतलब हमारा इनकम इतना और घट रहा है, जितना पहले था उससे घट रहा है 4.44। यस और नो?
यस
सर, नो? अगर पहले 5% था, 100 में 5% यू आर अर्निंग, सो 5 रुपया आप अर्न कर रहे थे, अभी ये घट के 1% कम हो गया, तो अभी कितना हो गया? 4 रुपया हो गया ना?
4 रुपए।
तो
यस सर।
तो कितना कम हुआ? एक कम हुआ, 1% 1% कम हुआ 100 रुपया में, तो 1 रुपया कम हुआ। सो इसमें भी उसी हिसाब से जो भी कमा रहे थे आप, उनमें से 4.44 कम हुआ। ओके, नाउ इफ यू थिंक अबाउट द लायबिलिटी, व्हाट हैज हैपेंड? 3 रुपीज 60 पैसा। सो लायबिलिटी में पहले आप 6 रुपया 6% देते थे सपोज, तो कितना पेमेंट करते थे?
6 रुपए।
6 रुपीज। अगर अभी 5.5 पेमेंट कर रहे हो तो कितना पेमेंट करना पड़ेगा? अभी चेंज हुआ है सपोज 0.5%, तो कितना पेमेंट करना पड़ेगा? 100 रुपए का ऊपर 5.5, तो कितना ये कम दे रहे हो इंटरेस्ट? लोग 0.50 क्या कर रहे हो? कम दे रहे हो या ज्यादा दे रहे हो? डिपॉजिटर को आप 6% पेमेंट करते थे, अभी 5.5 कम दे रहे हो, तो यही ये कम दे रहे हो 3 रुपया 60 पैसा। ठीक है?
यस।
तो कम दे रहे हो, मतलब ये आपके पास सेविंग है या खर्चा हो गया?
सेविंग।
सेविंग है। सो ये आपका सेविंग है, इसमें से इनकम से आपका घट गया 4 रुपया 40 पैसा, तो ये आपका सेविंग है या घट गया है, खर्चा है? आप 5 रुपया पहले सैलरी मिलता था, अभी सैलरी 4 रुपया हो गया, तो ये खर्चा है या ये माइनस है या प्लस है?
माइनस
सर आवाज
माइनस।
सिंपल थिंग
सर,
आई एम
आवाज-
आस्किंग। क्या आवाज? आपके माइक खराब है, आप आवाज आपको नहीं आ रहा है, बाकी सबको आ रहा है। Suppose your salary was 5 rupees earlier, now salary you are getting 4 rupees, then 1 rupee, it is a loss to you, or it is added to your pocket.
लास्ट
कम हो रहा है सर,
तो कम हो रहा है ना, तो ये माइनस है कि नहीं?
माइनस।
तो दोनों को जोड़ने से क्या होता है रिजल्ट?
माइनस
ये ज्यादा खर्चा किया आपने, ये आपका सेविंग हुआ, तो टोटल कितना हुआ आपको समझ में नहीं आ रहा? मैथमेटिक्स में नहीं है आपका,
सर
इसका डिफरेंस क्या है?
0.84
0.84 क्या है बताइए? 0.84 तो मैथमेटिकली, लेकिन ये पैसा गया आपसे या आपके पास आया?
गया।
अरे यार आपके पास
कम हो गया, कम हो गया
कैसे कम हो गया?
पैसा।
कैसे कम हुआ बता, कैसे कम हो गया? आप ऐसे ही तुक्का मार रहे हो या बोल रहे हो कम हो गया कुछ लॉजिक के साथ?
सर अभी एसेट पे तो 4.44
फिर आप एसेट लायबिलिटी मत जाओ, सिंपल इसको देखो, यहाँ पे क्या हो रहा है? 4.4 व्हाट इज हैपनिंग? आपने ही बोला ये कम हो रहा है और ये सेव हो रहा है, आपका मतलब ये ज्यादा हो रहा है। पहले आपके पास सपोज 100 रुपया था, अभी 4 रुपया 40 पैसा आपका खर्चा हो गया, तो कितना आया आपका? कितना आ गया टोटल? रहा कितना आपका? इतना रहा कि नहीं आपके पास?
9956।
ठीक है, ये आपका एनआईआई था पहले, अभी इतना खर्चा हो गया, आपका एनआई बन गया ये, अभी ये सेविंग कर रहे हो, तो आप इसको ऐड कर दो, कितना आया? 116 आया कि नहीं? ठीक है,
यस।
सॉरी, ठीक कर रहा हूं कि नहीं?
नहीं सर, नहीं सर, 102
above 95.56 sir.
95.56 होगा ऊपर वाला, यस।
हाँ, ये 95.56 होगा, एंड 3 मीन्स इट इज 99.60। ओके, अभी क्या हो गया? एनआई आपका 100 पहले था, अभी क्या हो गया?
99.16।
तो कितना हुआ? वो 0.84 डिफरेंस है कि नहीं इसमें दोनों में?
यस सर।
तो ये क्या हो गया? एनआई पहले 100 था, अभी इतना हो गया, कम हुआ या ज्यादा हुआ?
कम हो गया।
कम हो गया, मतलब डिक्लाइन है कि नहीं?
डिक्रीज, यस सर। क्लियर?
बस यही है। आप क्लियर बोल रहे हो, लेकिन मेरे को नहीं लगता आप क्लियर हो, आप फिर भी कंफ्यूज हो।
मैं दोबारा मैं रीड कर लूंगा सर।
ठीक है, ओके।
यस सर, थैंक यू।
सिंपल, ये सिंपल मैथमेटिक है। आपके पास इतना था, इतना कम हो गया, पॉकेट से गया और इतना आ गया, तो ये तो है 444 यू हैव स्पेंट मोर, 360 यू हैव सेव्ड। पहले आपके पास 100 था, इतना था, एडजस्ट होके 84 हुआ, तो ये 84 क्या हुआ है ये आपको मैं बता दिया। यहाँ पे 100 था, 99.16 हुआ, तो आपका 84 कम हो गया, नेट में ये कम हो गया। So due to that impact of different magnitude of rate of interest in RSA and RSL, 84 was the impact of NII, where our NII has declined. That is the answer. Okay.
Sir, please show that table, sir.
Which table?
That RSA is greater than RSA, that table.
That table is only applicable if the rate of interest fall is uniform. So second question, for second question this is applicable. Second question was that everywhere 1% fall is there. For such, see, यहाँ पे लिखा हुआ है, just see the impact of NII shown above are the result when the rate of interest changes uniformly for both asset and liabilities. If the changes are different, this formula will be not be applicable. Okay.
So if these changes, you can consider that RSL is greater than RSA increase. Is it, sir? RSL is greater than RSA. It is increasing. NIA. NIA
No,
increasing.
What you are telling, I couldn't answer. You tell me, what is your position?
Sir, if the RSL is greater than RSA, rate of interest for NIA is increasing. Is it, sir?
No. First, your position, this position is correct. Now tell me, see, this position is what? This is a gap is positive or negative?
Here,
this gap is positive or negative?
Positive.
How it is positive? This is negative gap. Liability is more than asset is a negative gap. What you understood that earlier I told you na,
yes,
when asset is more than liability, RSA is more than RSL, then it is a positive. When it is reverse, it is negative. This is a negative gap.
Yes, sir, negative.
Okay, gap is negative. There is no problem. Now you tell me what is the interest you are telling. Interest uniformly, it is increasing or decreasing, you tell me.
Uniform, in the case of uniformly.
Uniformly, you tell me whether interest impact is a increase or decrease.
Decrease.
Decrease. So you are telling it is decreasing by say 2%. Okay.
Okay. Yes, sir.
So what will happen? NII impact will be whether it is a positive impact or negative impact. You tell me. Rate of interest falling by 2%. Simply here liability is more than asset. So you will be saving more than your income. So your NII will be positive. Okay. RSL is more here. Rate of interest falling means you will save more.
Okay.
Then the asset earning. So saving is more than your earning. Saving and here also falling. RSA means your earning are falling, but your saving is more than the earning on the asset. So your impact will be a positive. Simple thing.
Okay.
Always this rule is applicable. So if it is not uniform also, you will see accordingly whether RSL is more or RSA more and what is the impact. You can just apply that logic and you will find whether it is so. What is the impact of RSL and what is the impact of RSA? Different is there. Say RSA impact for this interest change is say 8. RSA impact is say 4. That means what? Due to changes of different interest, impact of, so there is a fall, everywhere fall. So 8 rupees falling in liability side, 4 rupees falling in your asset side. So net impact will be what?
It's a negative impact.
How negative impact again? 8 rupees your fall in interest means you are, suppose 10 rupees earlier you are paying, 8 rupees less you are paying means now you are paying 2 rupees means 8 rupees savings or not?
Yes, sir.
You are really confusing. Liability side we are paying. This is a cash outflow. This is the outflow. Liability side is outflow and asset side is a inflow. So here outflow is reduced. That means you have to pay less. So you are saving here. This is your saving. Inflow is less. Means your income is also less. So your saving is more than your expenses. So what will happen? This will be positive or not? Yeah, I think you are still confused. You are also confused as those that to whom I was. So simple thing you do not understand. Now from pocket you are suppose giving earlier 10 rupees. Due to rate of interest fall you are paying 8 rupees. You are saving 8 rupees. That means your payment will be 2 rupees. Earlier 10 rupees you are paying. Due to change of interest which has come down, you are paying 2 rupees. So are you not saving 8 rupees? In same case, suppose your earning was 10 rupees earlier. Now it is reduced to 6 rupees. So means you are from your pocket. Earlier 10 rupees was your salary. Now it is reduced by 6 rupees. So you are getting 4 rupees. So what will be the impact?
Positive impact.
So it is a positive impact. You are paying less here. Say 8 rupees paying less, saving 8 rupees. Here your income is less by 4. So 8 minus 4, 4 rupees, your NII will be increased. Whatever the money was there, you are increased by 4 rupees. Okay?
Sir, please show the question one, sir. Third question, I want to note it down.
You are writing it down or taking a screenshot?
I'll take a screenshot.
That is better, na? Take immediately.
Yeah, thank you, sir. Got it.
Okay, see you tomorrow then. Okay?
Thank you.
Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you, Modi sir. Thank you very much.
Okay.
Thank you, sir.
Welcome, welcome. Have a nice day. Have a nice day.
Civil score, be interested.